Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 6th of July as we record. Some big topics coming up today. This week marks the publication of our annual Top 50 ETFs list, so we'll be discussing how said list has taken shape in 2023. Meanwhile, as rising rates lead to some perhaps unwise asset allocation decisions, we'll examine how investor preferences are changing in the context of those higher rates. On which note, we're also looking at banks' own saving rates, the subject of much criticism this week. We'll be examining what that pressure means for shareholders and why savers need to be careful with some of the deals seemingly on offer. Before all that, though, we will start with a company whose own fortunes took a turn for the worse long before the end of free money. That is banknote printer De La Rue. Joining me to discuss all of this are Julian Hoffman.
Hello, Dan.
Alex Newman.
Hi, Dan. How's it going?
Very well, thank you. Val Cipriani.
Hi, Dan.
And Dave Baxter.
Hi, Dan.
So we begin then with De La Rue. What was once a storied company has long since seemingly been circling the drain, as one of the present attendees said earlier today. Alex, full year results were out last week. Some signs of life there, but nonetheless a difficult road back for De La Rue at this stage.
Yeah, well, I mean, we can still say it's storied, maybe not for all the right reasons. The problem with De La Rue for a long time is it's been flailing around for a convincing growth narrative. So there were signs of life with these results, and that led to a bit of a relief rally in the shares, which were 10% up on the day. But there was, little signs of life really in the full year results as reported. So they had a £30 million IFRS loss, which reflected big impairments that they described as exceptional charges again, though, I mean, it's certainly part of a non-exceptional pattern of sort of restructurings and contract losses that they've had to account for. So over 5 years, I was just looking back at their, from a financial position, how things have been going. Sales are down, nearly 30%, which is a lot faster rate than of decline than costs. So that means operating income has halved, and of that total operating profit generated over that period, about a fifth has gone on impairments and charges. So, yeah, the circling the drain accusation or tag feels appropriate when you look over the past half decade. The big problem, they've got now, and is they're quite an indebted company. Net debt is set to hit £100 million at the half year. And so they're currently paying about 8.5% on their debt. And that's, if we sort of believe the markets today, that's likely to rise to possibly 10% by the end of the current financial year to March. That means then that annual interest rates are suddenly, pushing quite above £10 million. And yet their operating profit is sort of forecast to edge to the low 20s, 20 millions of pounds in 2024. So it's a really uncomfortable picture from a financial perspective.
Some of that rally, as you said, was because they had some new debt covenants. They've managed to delay the pension contributions they need to pay for a couple of years. I mean, to me, that all sounds very much like kicking the can down the road. They would say, I'm sure, it buys them some breathing space. What's your, is it possible to say which of the two it is at this stage?
Yeah. I mean, I would agree. I think it's important to see. Sometimes it's important to see rallies for what they are. So I think in this case, when a company says its lenders are relaxing their covenants and there's, a bit of breathing space in the pension deficit, it doesn't mean we're at the beginning of a turnaround. Some of the analyst commentary was around that we're at the trough here. But it just means there's more time to find a solution, which is in everyone's best interests. And, we don't have this material uncertainty around the going concern question hanging over everything. But yeah, I mean, cash flow is really what's going to keep the lights on here, and there are big questions about that, not only from what we've seen in recent years, but what they're able to do in the coming years.
Yeah, you're right. Actually, the problem really is that the company, at least from the company's perspective, they have the lenders by the proverbials, in that there's only 19 million of equity left in De La Rue. And if the lenders were to pull the plug tomorrow, all they really would get is a wait behind HMRC for payment out of whatever's left. and they owe HMRC something like 23 million alone in accumulated tax losses. And basically, it is a classic case of, well, if you borrow £1 from the bank, you're a servant to the bank, but if you borrow 100 million from the bank is a servant to you. So I wouldn't personally read too much into the idea that was a recovery. I think that just the fact that they could get some breathing space on their covenants just reflects the fact that the banks won't get anything if they demand it all tomorrow, except for a warehouse in Basingstoke somewhere that will be emptied of equipment.
Well, I suppose the question is, the question maybe if this will happen, but I want to know sort of potentially where growth could come from. If things were to go right. Obviously, currency, banknote printing is 3/4 of the business still. There's also an authentication arm, which is, is forecast to grow at a relatively quick pace in the next couple of years. But we have seen that before not come to fruition effectively. As you said, Alex, it's still losing contracts, which some of the exceptional charges are effectively just dealing with the loss of contracts, which, when you're in a bit of a potential death spiral, you can see the potential for more exceptionals coming as more contracts are lost. But nonetheless, they do have some areas of potential interest. They have a contract with Microsoft on the authentication side, for example. I think that struggled because Microsoft is selling fewer PCs, so there's a cyclical aspect to that. But maybe structurally that could be a benefit in the long term.
Everything about this business seems to be in a a cyclical downturn. I mean, how many people carry cash anymore? I mean, even out here in the wilds of Devon, Dan, we use tap and pay, and it's and that was long before many of my people in London were doing the same. But I mean, it doesn't seem like that the business has any part of it, from my point of view at least, that you could say makes it long-term viable.
We should, in fairness to them, I mean, the outlook was a lot brighter, the tone was a lot brighter than it has been recently. And then they're sort of saying that there are encouraging signs of recovery and sort of a good rate of contract wins, which are coming back, and there had been a little bit of a pause. And I suppose the other caveat to the sort of quite obvious structural decline story about moving to a cashless society is that, it's not just the UK or sort of Europe that De La Rue serves, that there is, it's a global business serving economies where cash is still the dominant payments mechanism. But I mean, the thing I found a bit jarring about these results is that, 3 months ago we were told that the core currency market was at its weakest it has been for 2 decades. We got 3 months later, and we're sort of there encouraging signs of recovery. It's a bit hard to resolve what might be is definitely appears to be a structural decline with what might be a sort of blip in or upturn in contracting. So it's a bit hard to read. I found from these results, but then I suppose it always is from a very small snapshot of trading.
Mate, you could put the money into this as a speculative punt, but I would venture that you'd have to be prepared to lose it in the long term.
I suppose another potential growth area has been the polymer banknotes. The shifting from paper to polymer. Although I think in the analyst call, when asked why they hadn't mentioned polymer in the latest figures, they said, well, there has been a short-term sort of blip in growth there as well. Obviously, short term is their description of it, but that's potentially something too, which could be a tailwind if we're looking for such things in future. As more countries do what we do and shift their notes to that style. Final question, maybe on De La Rue. Last year there was some talk. Crystal Amber, the activist investor, was pushing for a breakup. Would there still be much point in such a thing when we're looking at a company with a market cap of only, even with the rally now, is hovering around 100 million mark? Splitting off the authentication division, it's a quarter of revenues, something like that. Would be acquirers now just be waiting for the end, or would they potentially be looking at doing something or making an offer for the entire company?
Yeah, I mean, you can never rule things out. The enterprise value of the business is now 40% discount to sales. So, if you're very long term focused and you're able to absorb some of this, the debt they have in the business, then maybe there's arguments to be made. Certainly with the authentication business, there's probably a broader range of buyers for that arm. And the Crystal Amber the argument they were making at the time last year, which is the beginning of 2022, was that there's more value there than the whole market capitalization of the business. So whether a breakup is the best hope for shareholders, is maybe one of their, sources of optimism. I think the point to emphasise here is that there's been a big difference since the start of 2022 and today, and that's the cost of capital. So the prospect of competitors just coming up and hoovering up this business really requires a sort of compelling financing case for them, assuming money is equally tight at their end. The currency division is not a compelling growth story, so how from the other side of the table you make that case, I'm not quite sure. So it probably would be the growth business, if any, which is going to be the saviour here. Yeah, I mean, can't rule it out, but we could also have alternatives which may be less exciting for shareholders.
Yeah, I think that's fair to say. But you would hope at this stage most shareholders would appreciate that as a real possibility given the direction of travel over the last few years. Let's turn to something more positive now. Our cover story this week, our top 50 ETFs piece, our annual feature, the 10th year, Dave Baxter, our funds editor, of doing this this feature. Why don't we start just by kind of, laying out the ground rules for what we're trying to achieve here and what we're looking to do. I mean, you could say it does what it says on the tin, but how do we sort of look to construct this list?
Yeah, hopefully it's relatively self-explanatory, but I suppose we frame it as kind of low-cost portfolio building blocks. So if you do want that passive exposure, what we're looking to identify is the best funds in terms of price, but not just price, also whether it tracks the most appropriate index for a given region or theme or area. And also we tend to like the funds that are kind of pretty big, because that should normally bring you a decent level of liquidity, and it should, rein in some of those costs that you don't think about so much, like transaction costs and that kind of thing, and trading spreads.
Yeah, as you say, the idea is to make it, at least from first principles, quite straightforward, building blocks, something easy to get started with, but it can be easier said than done, even with ETFs. We say price. Obviously, we had our kind of cheap funds feature a few weeks ago. This looks at some of the other factors in more detail, because choosing two ETFs tracking, say, emerging market index or something like that, they can be quite different from one another. Even if they, both track their respective indices quite closely, those indices can be markedly different in makeup, that kind of thing. So there's a lot of that in the piece as well, isn't there, about how investors should think about all these things, and the fact that there is more to think about than when making these selections than just finding the first one on the list on your platform and buying that. The other way we structure it is kind of a three-pronged approach, really, with a core section and then two smaller sections.
Yeah. So as you mentioned, we have the core one, which again, hopefully is self-explanatory, but it's your S&P 500 trackers, your MSCI World trackers, the kind of, focusing on those really big established markets that perhaps you would want to form obviously the core of your portfolio. Then the satellite list looks at slightly more kind of targeted funds. So for example, dividend funds. We've in recent years had a few kind of investment style factor ETFs, so kind of value ETFs, minimum volatility ETFs, that kind of thing. And they're a bit more interesting, but perhaps kind of smaller positions where you want to add a bit of edge in your portfolio. And then going even more specialist, we have a very small niche category which contains some commodity products, and also we have, a kind of a smattering of thematic ETFs. There are some quite big criticisms of thematics, but given people are quite interested in them, we do just highlight a few options there as well.
Over the past few years, or over the last couple of years, there hasn't been too much change to the list. This year, however, there are a few. Without pulling the curtain back on, exact names, things like that, can we say a bit about the kind of funds that have come in and dropped out in terms of the nature and the thinking behind some of these changes?
Yeah, so there are a couple of maybe not exciting changes where we've simply swapped out funds where...
Don't downplay it, Dave.
I know. But a couple where it's kind of, for reasons such as a different option has better trading spreads, that kind of thing. But the more exciting options, I'm going to use the word exciting a lot, relate to perhaps the structure of the list and what you might be getting. So, for example, you kind of alluded to some markets have kind of skews and compositional things you need to be aware of. One example, you have the US market clearly is so dominated by the likes of the tech majors. And as an offset to that, we've included another option that takes a equal weight approach to the S&P. So it gives every holding and every kind of share in the S&P 500 something like a 0.2% weighting. So what you're doing is you're stripping out that massive bias towards big tech, and you're bringing in more of a kind of small cap focus.
Another feature we have this week, and related feature, is looking at how people can complement these kind of funds, because obviously for a lot of listeners and readers, they might have a couple of ETFs, a couple of passive funds doing certain things, and they'll add to that various either active funds or shares or things like that. So the feature we have this week, which admittedly you didn't write, but is looking at what you can complement a global index tracker with in your portfolio. So
yeah,
I think that's quite useful as well to talk about that, because for a lot of people looking at this list, they'll be interested in just a certain part of it, and then they'll be thinking how to do things differently and in a bit more of an interesting way outside of that. So what are kind of some of the things people can think about if they have a global tracker? What can they kind of add to that?
It's interesting, isn't it? Because I suppose that's those areas where you might tinker. That's where you add more character to your portfolio, and you might actually add more kind of growth. But one example is kind of smaller companies. Another example, I suppose, is regions beyond the US, because the US is just so dominant when you look at the composition of your average global equity tracker. And then I suppose other areas are kind of sector funds. You might begin to look at the likes of single country funds. So if you look at emerging markets, an emerging markets tracker is very China heavy, but people may want to focus more on areas like India, which is very in vogue in the last year or so. So you can kind of double down on some of those allocations.
Yeah, over the last few years, some of those decisions have become certainly, if not more pressing, than people have certainly become more aware of them. The US, as you say, is more than 2/3 of global indices now. China, obviously, is a region that a lot of people increasingly want to avoid. Some people might see an opportunity there, but others, are very much, in the uninvestable camp. So there are these asset allocations decisions to think about with everything you do, not just, even if they are set and forget funds.
Yeah. Yeah. And it's like you say, we've really seen those biases have become pretty obvious. Last year, the US kind of big tech stocks sold off pretty heavily, and, China has continued to weigh on emerging markets funds. The great reopening trend we were talking about at the start of this year just hasn't really so far done much to move the dial. So
yeah, that's certainly a trend I thought would do more to.
I remember you talking
at the start of the year, certainly in terms of returns, but that hasn't happened yet. So
early, not wrong, perhaps.
Well, I don't know. I'm starting to think wrong, but that's probably a good contrarian sign if you're doing the opposite of what I say. As I say, that is our cover feature this week, so do pick up a copy. We have the full table in there of the full 50 funds across all categories, across all equity markets, and some non-equity ETFs in there as well. We are now, though, going to shift gears only slightly and talk about asset allocation from a different point of view, the perspective being the number of investors who are now starting, if you look at the fund flow figures, to shift out of equity funds into the likes of high-yielding bond funds, even into money market funds as well. Obviously, you can get, and certainly in the UK, you can get rates of 5% plus now on such things. The question, though, really is perhaps if we start with the asset allocation point of view. Alex, I'll come to you again on this. Investors are looking for those kind of assets. Is there a danger of, if not the tail wagging the dog, then there's a danger people think, oh, well, I can get this very high yield now on a bond fund or even a money market fund, that they kind of upend their entire strategy to do that. And then they end up, if not now, then certainly in 6 or 12 months' time, sort of wondering what they do now. Yeah,
certainly. I suppose you've had in recent months people waking up to levels of seemingly risk-free income and yield that you can earn, and after a tricky year and a half for equity investors, if these these hypothetical swing voters were in equities, the prospect of just locking in 5%, will certainly feel compelling. I mean, at an institutional investor level as well, I suppose, if you're a annuity or pension provider, there you can sort of see the logic in this shift to higher yielding assets and bonds. I suppose, yeah. I mean, there's a lot of different components to this because it depends on what the hypothetical investor saver we're talking about here is. Are people looking at their outgoings and their sort of monthly cash flows and saying, what I want is coupon payments or a monthly top up of my income from savings now because everything else is feeling quite stretched? Or are people thinking about the long term and thinking this feels like a safer way to compound my wealth, and I would take 6% from equity returns in any ordinary year, so I might as well do it more safely. So it's a fine balance here. You are with bonds and some safer high yielding products, also sort of locking in a loss when inflation is still running at nearly 10%. So there's that in the mix. It's a hard one. I think it's just, maybe we'll come on to talk about the banks and the savings rates questions there. It's really hard to know what the hypothetical saver investor is we're talking about here, because I think circumstances really do depend on your horizon and also your immediate needs, which for some people they're having to step back into thinking about different products because their month-to-month circumstances have changed. So,
well, on the subject of savings rates on traditional bank accounts, if you will, Val, you've written about this week. Again, there are a number of aspects here, but if we focus just on people, looking at something which we don't typically talk about too much on this podcast because it's not, strictly investing, but it is something which is attracting more people now, given even on certain savings accounts you can get 5% plus. But sometimes some of these deals aren't quite what they are cracked up to be. Is that fair to say?
Yeah, I think that's fair to say. It's not a new thing per se, because it's always been the case. Like, you look at advertising and then you look at the terms and conditions, and usually they're two different things. It happens fairly often. But I think with saving rates being higher, they look even shinier, if that makes sense. So, if you go and see like, hello, here you can get 7% on your cash, you will think, well, I want this thing. It's fair to say that you would want to take a better look, especially now, at what exactly these deals mean in terms of how much money you're gonna make out of it. And I think the best example here, and again, it's always been, but it just looks that way more now, it's what they're usually called like a regular savings account, because they have this very kind of like higher than the rest rates advertised. But that's because they have quite low limits on how much you can put in every month. So basically, you can put in, for example, say 200 or 300 pounds a month, and you will have often your cash locked in for a year, so like a fixed term. And so what happens there is that in practice, you will get your 7% on what you put the first month, and then gradually, on an annual basis, it will inevitably like lower down. And so what that means is that those accounts are great if you're actually looking to put away some money every month and kind of like encourage yourself to save on your income. But if you already have the savings, you're typically better off with a fixed term account from the start, because then the math just doesn't add up. And obviously that's just an example, but the case I think I was making in the column is that banks are especially keen now to show that they are giving back some of the profits they're making on mortgages to the people who are banking with them, to the savers. And so they might sometimes get a bit more aggressive with their advertising, and you kind of need to be a bit more careful than usual, basically.
Yeah, I think even this morning, again, Thursday, as we record, there's been, the banks are up in front of committees today, and unsurprisingly, several have announced this morning some higher savings accounts ahead of that. But yeah, there are things to watch for. That regular saver thing is a case in point. And as you say, you can't typically put lump sums into there to begin with either. Certainly with the big banks, if you look at, if you have a current account with a big bank, as I do, you look at it, and the only way you can get anything near the top rates is either with that kind of starting from zero or with a fixed term account, which, is fine in some circumstances, but some people may not be able to lock their money away as well.
Yeah, no, definitely. And also, like, there's different fixed terms. So, for example, if you have a 1 year, that might even make more sense. But some of them are, 3, 4, 5 years longer. And again, if you can afford to lock away those savings, that money for that long, you should probably think about investing it at that point.
Yeah. And the other thing to say nowadays is, be aware, I suppose, of the personal savings allowance, because if you're a high rate taxpayer and you're not in a tax wrapper account, you're quickly going to see that 5% rate become something more like 3% when you account for the 40% tax you have to pay on it. Julian, from the shareholder point of view, we're talking about banks here. Again, there's political pressure on at the moment to pass on these rates more widely, or at least to be seen to be doing so. At the same time, banks have already said, as we've discussed on this show, that they think that net interest margins are, not going to be quite as high this year as people first thought. Perhaps partly because there is some of that pressure now. Is this something shareholders should be considering if they're still holding on to banks?
I mean, arguably they've already been discounted. I mean, none of either banks are either flat or slightly down at this point. And they gave up they actually made their biggest moves last year in the expectation of a decent first half.
Yeah.
So from a shareholding point of view, I don't think it actually makes any difference. You might want to consider whether, in fact, if there is a discount move going on, you can eventually buy back in at a point where interest rates go up again, or the expectation that interest rates will go up again, and then you might see another re-rating of shares. So actually, for shareholders, it doesn't make a huge amount of difference. I mean, it's all about the kind of political battle between savers and the government, and that kind of that sort of triangle, on the banks in one corner. But I mean, there's nothing really they can, unless the only thing that the government could do would be to sort of change capital ratios, which might force them to, in a sense, pay out more. But there's no sign that they're going to do that at the moment.
I mean, from shareholders' point of view, the story has already moved on to an extent, hasn't it? From the net interest income increase to the risk of recession and what that might mean for the other side.
I mean, everyone's well worried about the loan books now.
Exactly.
It's nothing really to do with the deposit side of the business.
Which does mean, if probably in a lot of cases, if you want those high deposit rates, you're going to have to open another account with a challenger bank or something, and then there's some admin involved in keeping track of that, etc.
If you want really, you have to go to Ford Finance. You can get 6%, but I mean, it's there are options out there. It's just a question of finding them, really.
Yeah, Alex. Another thing we've spoken about before on the podcast is the implication of a higher risk-free rate, and investors or savers, moving to these kind of accounts for the likes of dividend income investing. There's some still fairly juicy yields out there in the UK market, but at the same time, they're now competing with a 5% base rate. So what does that mean, really, if anything, for income investing? Does that mean people have to be more cautious, be more aware of what the relative return is they're getting, in short?
Yeah, I mean, definitely. The net effect is it just raises the bar for what we should expect of companies' returns, really. So, if Bank of England rates are now heading towards 6.5% by next March, and in our trader email this morning, we picked up on a JP Morgan note saying that they think interest rates need to hit 7% to properly tame inflation.
I think that was a worst case scenario.
That was the worst case scenario. Okay, important caveat. But I mean, we've got further to go.
The worst case scenario does seem to keep getting worse. So yeah.
But yeah, I mean, the net impact on equities is they have to offer a compelling, above historical trend growth rate at a time when we might be heading into recession. Okay, UK equities aren't as plugged into the UK economy as other market indices. So there is that. There is, I suppose, that hedge there. But the FTSE 100 and the all share yield about 4% at the moment, and they trade on a forward earnings multiple of about just over 10. So you have the equity growth story long term, which you've got to factor in. It's not just about comparing 4% dividends with 5% coupon payments from gilts or whatever it is. But definitely the risk reward trade off is getting harder for investors to calculate, which is it's true, I think, to say that it's becoming more compelling to own bonds, with the enormous caveat that inflation hopefully is going to come down over the next year, because if it does stay elevated, then which it well might, then you are locking in sort of a guaranteed loss. Whereas there is always this opportunity with equities to sort of to find some alpha in the broader investment asset universe.
Yeah, well, as with all these things, it's a movable feast, isn't it? And who knows what the situation will be like in 6 or even 3 months' time. But we will continue to monitor these things, of course, and continue discussing them on the show. But for today, that brings us to the end. As I say, we do have our top 50 ETFs issue this week, so pick that up. And dividend investors can look forward to Phil Oakley on BT and a range of other features as usual in the magazine this week. But thank you to everyone this week for the podcast, for joining me. Thank you to Alex, to Julian, to Dave, and to Val. And thank you to you for listening. We'll be back next time with another Companies and Markets show.